Hey, thanks so much for checking out this very special episode of Coin Stories, where I have the honor of chatting again with Preston Pysh about a fascinating Twitter thread that he put out looking at the state of the global financial markets and just how manipulated everything is by the central banks and this inflationary monetary policy that we have going. Now, I wanted to get a breakdown of some of the charts that he included and really understand how Bitcoin plays into this because things are just so wacky and I feel like everyone's expecting a bust at any moment. This episode is brought to you by the Bitcoin Conference. It's going to be held in Miami next year, April 6th through 9th. It is the best Bitcoin event you could ever attend. If you want tickets, head to b.tc/conference and use the code COINSTORIES for 10% off. This episode is also brought to you by OKCoin, one of my favorite places to buy Bitcoin and dollar cost average without the crazy fees. You can go to go.okcoin.com/Natalie for $50 in Bitcoin when you sign up. Here's Preston. All right. Well, Preston, thanks so much for coming back on my show.
Absolutely. Anytime.
Okay, so let's talk about the state of the financial markets because you put out this really, really fascinating thread picked up by a lot of people responding to it. So talk to me because right now, Omicron is sort of the thing that people are saying is affecting the volatility in the markets, but I personally think it's a little bit because the Fed is between a rock and a hard place. They go inflation, God forbid, to 10% in one direction. And we all know that the CPI, the numbers they're putting out are not factual, or they potentially, crash the market with a rate hike. So can you talk to me a little bit about where we're at? And then we'll go into some of the specifics of your tweet.
Yeah. So I completely agree with what you just said. And it almost appears like they're just latching on to anything that could justify why the markets are getting a little wonky right now. And so the virus is just the natural thing that you're seeing a lot of the mainstream media chirping that that's the problem. That's the problem. But I don't know. I was in New York City a couple weeks ago. People were out and about. It didn't seem like they were too concerned. I was at a sporting event. Everybody's walking around wearing boxes. There's nobody wearing masks. And to me, I'm not seeing the real impact for people that are concerned about the virus or not going out because of the virus. So you talk about interest rates and you talk about the inflation numbers, and I think that that's the bigger piece here. And what I think is so concerning about some of that is the last CPI print, the number they're telling you, and I think that's really important to emphasize that 6.8%, and you've got the 10-year treasury at 1.4, 1.5%. And so that just doesn't even make sense. And so that's the part that's really kind of getting concerning as you're looking at the rest of the market. It looks like it's starting to stall out. It's a little hard to say whether you are or you aren't based on the statistical volatility that you see in the markets. This could just be another kind of blip and then it goes on another rip. It's kind of hard to tell where we're at right now, but it does look like it's starting to stall out. So if true, and they haven't raised rates yet, all they've done is the forward guidance where they say, oh, we're going to raise rates or we're thinking about raising rates, but they haven't done anything yet. And so what you're seeing in the rest of the bond yield curve and the duration of the curve, the only thing that they're playing around with, at least historically, the only thing they've really played around with for the most part is the federal funds rate. The rest of the curve has started to sell off. The long end of the curve, the 20 to 30 year, is actually bidding, and the rest of the curve is selling off, which is going to reach this parity where everything's at the same yield, which is called an inverted yield curve or a flat yield curve. And that's when things start breaking, is when that happens. So you're seeing the yield curve start to move in that direction, and they haven't even moved. They haven't even adjusted the federal funds rate yet. So that's where like you, and I think some other people that are looking at the market, they're saying, hey, is this really the virus resurging itself, or is there some really weird stuff happening in the fixed income space, especially with the CPI prints that we've seen so far?
I'm kind of curious because I always thought that before a major correction or crash, people aren't really greedy. It's almost like people aren't fearful. They're not like fearful and the index isn't in that direction. That's almost always been bullish, right? And people are sort of on the sidelines, but they're ready to throw in some powder. But now it just feels the opposite. It feels like everyone's expecting a massive bust to happen at any moment. Do you feel that way?
Yeah, I feel like we're due for a correction in the coming year. It could happen sooner than that for sure. Like I wouldn't be the least bit surprised if it happened sooner than that. But I would be surprised if we went into like 23, like the middle of 23, if we still hadn't seen the market kind of throw a fit by then. I'd be really surprised. So I think that's kind of where we're at when I'm looking at the yield curves and when we're going to probably get that inversion. And this is really hard to kind of forecast, but based on the rate of the sell off and the rate of the bidding on the long end of the curve, it's looking like in the summer of 22 is when you're going to start to have the bond yield curve here in the US start to invert. Now, I would caveat that with over in Europe, if you look at their bond yield curve, it's just a straight disaster. Like it's a mess. Everything, the whole duration is just compressed down to nothing. So you could maybe have some of these other markets start to lead this sell-off. And if you look at the equity markets and you chart them out, which is going to a little bit of like the post that you were referring to, when you're looking at these other markets and you're looking at their indexes, they seem to be rolling over. They seem to be breaking the statistical volatility range, where here in the US, I would say we still haven't broken out of that yet, but maybe the rest of the global economy is actually pulling us in that direction.
Yeah, no, it's really interesting. Okay, I'm looking at some of the charts that you put up because it looks like we've just gone up and up and up ever since the last financial crisis. In the first chart, you show that India, before you make the adjustments, India increased the most with 638%, then the USA. So tell me a little bit about why you shared these charts and what you want people to get out of these.
Yeah. So in the thread, if people haven't seen the thread, hopefully you'll have a link in there, I'm sure, so for people can look at it. What I was doing is I like to look at the global market collectively. So like, let's look at all the indexes. Let's see whether this credit is expanding in the system or contracting in the system. Because when you're thinking about how markets move, there are two different things. You got monetary baseline, which is the money that the Fed would say is an actual entry as far as a fiat unit. And then you have all the credit that's constructed on top of it. The problem for market participants is they don't realize that they both spend exactly the same. So when you have these two pieces, you have the monetary baseline and then you have the credit in the system, but the credit in the system is like, who knows how much of that is in the system. It's not like Bitcoin where we can just audit the blockchain and say, this is how many Bitcoin are right now at this moment in time. When you're looking at credit, I mean, you and I could come up with an agreement right now. Hey, I'll pay you back $100. I'll lend you $100 of credit and I'll pay it back to you at whatever date. And we just created money in this system. So now you can take that promise and you can add that into the economy if somebody else is willing to trade you for that promise. And this happens and happens in billions and trillions of dollars. So what I like to try to do is I like to try to model that quote unquote credit in the system and how much it's expanding by looking at all the indexes across the entire planet, the stock indexes, and then collectively kind of compile them into a single index. So when you do this, you got to make a lot of adjustments. So like India, for example, if you're looking at the chart and you're seeing India and they had a 600% return since the bottom of the financial crisis in 2009, you're looking at that and you're saying, wow, they've done really well. But you have to think, okay, that's denominated in their local currency. And you have to put everything in like terms. So the first thing that I do is when I plot out all these different countries is I have to normalize them into US dollars so that I'm comparing apples to apples and not all over the place. So when you do that, you can see that it might look like India was the best performing, but after you account for the currency, they were second best in the whole world. The US was the first best. So I make that first adjustment. The next thing that you really want to do when you're doing these adjustments is then you have to account for the M2 money supply, because once you put it all into dollar terms, well, the dollar isn't the same from back in 2009. It's been debased very heavily. And you could even make the argument that you're not even accounting for the amount of debasement that then is happening on top of the M2 money supply. So maybe it's even worse or maybe more exaggerated than what I'm even showing here.
Yeah, it's crazy. A bunch of them all of a sudden go negative when you normalize for that.
Yeah. So when you're looking across the globe, everything's positive by a lot. And as soon as you normalize it for the M2 money supply and you're putting it back into, because everything's now in dollar terms, now we're going to put it back into basically 2009 money. And now let's look at how things have done. And when you do that, you see half of them start going negative, maybe even more than that. I can't remember, but there's a lot of them that start turning negative. So then the last thing that I like to do is I like to say, okay, so when you're looking at all those lines, you're saying, all right, the US, like, is that the line that's really kind of driving the overall market? What percentage or what proportion of the US market encompasses the global economy? So the next thing I do is I weight each one of those lines and then I consolidate them into a single line that's been all turned into dollars and then all adjusted for M2. And when you look at that, you look at that line and you look at what's happened since 2009, we've literally gone nowhere, right? As far as the appreciation, the market cap of equity through that period of time.
Yeah, well, it's really interesting. It went to 6.9%, went up since the 2009 bottom, and yet we're at inflation, which is 6.8% that they tell us. So basically, we have nothing. Since then.
Well, you've had a market from a capitalization standpoint in buying power, and I think that's the emphasis. The word to use is in buying power terms, everything's just completely flat since 2009. And that might be really difficult for people to imagine being the case. And the indexes that I used, I tried to use some of the broadest indexes for like the US. I'm using the Russell 3000. So I'm taking 3,000 companies that represent the US. Over in Europe, I'm taking the top 600 largest companies. And so like, I'm really trying to use the broader markets and not use like the Dow index, which is just a few smaller companies, to kind of represent this growth rate and market premium for how things are being valued. But I'm looking at that chart just so you understand, and maybe people listening, I'm looking at that chart more to gauge whether we're having credit markets start to roll over. That's how I'm really looking at it. So when I'm looking at it and I'm seeing since the bottom of the COVID-19 crisis, when everything sold off like crazy, a person who's looking at the charts and not making all these adjustments, they'd be looking at them and they're still going up. There's, like I was saying, we're starting to get into this volatility where maybe the volatility is demonstrating that we're stalling out, but it's a little hard to really make that call with a lot of confidence right now. But when you look at this consolidated chart that's been adjusted, you're seeing that it is rolling over. And so that's why that's why I do this, is so that I can see that. And it looks to me like there's trouble ahead, like in the equity markets. And so in Bitcoin, there's most likely there's going to be pressure put on Bitcoin that it's going to struggle to perform and maybe go to like these $100,000 calls that a lot of us were really hoping for. Maybe it's making that a little bit more difficult just because there's not as many fiat units in the system.
Yeah, no, I completely see that as well. And right now, I think that Bitcoin is correlated to a lot of the fear and the uncertainty and the frothiness, if you will, of the traditional markets. But just out of curiosity, what's your take on if this bubble pops? I mean, I would argue that this is a lot bigger than the 2009 bubble. This treasury bubble that we have is a lot more delicate, and the crash could potentially unwind much more aggressively than I think it did in 2009 and take everything down with it, including Bitcoin, at least temporarily. So, but having said that, you know, the response would, it's always just been more money printing, right? So we would move into the direction of even more inflation. So what are they going to do? I mean, where do you see this going?
They have to print more, like a lot more. The whole 2009 has never been solved.
Yeah, exactly. Got worse.
Yeah. Everything that's happened since 2009 is just them trying to prevent what was supposed to happen back then, which is a flushing of the market. People who have some type of liquidity are then buying up assets for pennies on the dollar, and that's getting capital. All that capital reallocation is happening. That's what you need to have a healthy economy.
Yep.
And they're not letting it happen. And this next event is going to be just more of the same, because Even back in 2009, they were talking about too big to fail. Well, now you're like too big to fail times 100 or 1,000
Yeah.
compared to where we were at in 2009, so 2008. So, what they're going to do is they are going to drop rates. I believe on this next, I call it the market throwing a fit. The next time it throws a fit, they're going to have to step in on throughout the duration of the bond yield curve. So to date, they stepped a little bit on this last one with the COVID-19. They started playing in corporate debt and things like that, and there was a lot of people like, "Hey, what in the world's going on? How are they able to do this?" You're going to see a lot more of that. I think you're going to see them play around throughout all durations of the Treasury curve. I think you're going to see them implement yield curve control, where they're going to say, "Hey, the 3-year is at this yield and it's not going to go higher. The 10-year is going to be fixed at 50 basis points. The 30-year is going to be fixed at 1 basis point or 100 basis points." And it's going to get very strange. And I think that you're not going to just see it in the US, you're going to see it all over the world, except for I think the rest of the world's going to be 0% across the entire duration. And this is what's going to, I think this is what's going to make this time around so much different than any other time since 2008, 2009. I don't think you're going to see the inflation numbers get back down to where they were when we were like less than 2% or 200 basis points. Those days are over, in my opinion. Those days are over. And I think that's going to be the thing that really throws things into chaos with respect to just financial markets. Whether it throws like social unrest and stuff like that into, I have no idea. But as far as like financial markets go, I think you're gonna have this line of thinking. Wall Street's going to look at this and say, all right, they did 5 trillion units inserted into the global economy during COVID-19, and it produced this 6.8% inflation number like within 12 months later, or, a year and a half later. Now they're saying they're going to do 10 trillion, maybe 15 trillion to stop the insanity. Is the numbers that I would expect. I have no idea what they're going to come to the table with, but on a global collective scale, it would not surprise me if we're talking like 10 trillion units added into the system. And those are monetary baseline. Remember, I was talking two different things. You got monetary baseline, and then you have the credit. So I think they're going to bring like 10 trillion units into the system, monetary baseline, and then you have all this credit that'll get constructed on top of that. Okay. And I don't know what the number is, but it's going to be a number that blows everyone's mind, right? And when they step in, you're going to have all these people saying, hold on a second. Like, how the hell can they keep doing this? Because you're already having tons of people ask that right now. And if the last time, which was half as much, brought in 6.8% inflation, what in the world is this going to bring?
Exactly.
And what you're watching is you're watching supply chains break down because there's no cost of capital for economic calculation. Safedine talks a lot about this in his new book, The Fiat Standard, which is amazing. Everybody should read it.
Yeah.
But I think that's the thing that we're watching right now in real time. We're watching supply chains break down, which is a function of economic calculation being completely broke because people can't determine what value really is anymore. I think that it's just going to exaggerate. And that's where I have concerns of like them being able to hold this all together.
Right.
I think that's when it really starts to come off the rails, is when they're having to do yield curve control at nothing percent. Rates can't go up. People are going out and getting a 30-year mortgage at 1% or whatever the number might be by then. But yet inflation is at 10% plus. And that's the number they're telling you, which we all know it's higher than that because it's just how it's nesting, how all that freshly printed units are nesting itself into the economy. So, yeah, I think we're getting near the fireworks period of time.
It's really insane. And it's crazy to see Fed sort of do an about turn, right? Now he admits that it's not transitory. But then I don't know if I'm sure it frustrates you. You see, people going up on behalf of the administration, saying that the price increases are the result of corporate greed by like I mean, are they that ignorant that do they really not know anything about basic economics being up in their positions, or are they that bad of blatant liars to this country because they can't admit what's actually happening? I mean, it's really frustrating to me.
It's very frustrating. This is what I would pose to people that are thinking through this and just frustrated with the system. If you were in charge, and you have to keep calm, you have to keep a semblance of you're trying to keep the social unrest from like really flaring up, right? I think they're just trying to say anything, literally say anything to try to calm or have people just kind of divert their attention to other places. That doesn't make it right. I'm just suggesting that maybe that's why they're acting the way that what else can they do? The last thing they want to do is go out there and be like, yeah, this is uncontrollable. In fact, we don't even know if we can stop it. In fact, we're going to have to print more, which could make it worse. I think if they came out and said something like that and was just really blunt, like we would say, I don't know if that would I don't know what that would do to the markets. I think the markets would go haywire. I think they'd go berserk. Which would then just ravel into this scenario they're going to have to do, which is print more money. And that's the thing, is no matter what they do at this point, I think we are at the point now where no matter what they do, they have to print more, and they're going to have to do it aggressively. So you can do that today or you can do it tomorrow, but you're going to have to do it.
Yeah, so I mean, there have been a lot of strategists that have been predicting a bust for a while. I know Peter Schiff is obviously one that's been waiting for a crash for the last 10 years or more. But there's some others that I've talked to that are really interesting that say we're obviously way overdue, and the Fed is in between two very, very difficult spots. And if we were to have a breakdown, this like a deflationary bust, it would take us down potentially 50, 60, 70%. I'm curious, do you think that is possible, or do you think that they would basically kick in at, before it got that bad with just more money printing to try to inflate it? And can they really keep that going? Because at this point, I don't think anyone really trusts the markets or the Fed anymore, even in the traditional space. And I think it is the best value proposition for Bitcoin, because if they keep doing this, you have to seek out that scarce refuge that is Bitcoin, because there's not much else. Obviously gold, yes, but it's completely underperformed even in this inflationary environment.
So the reflation that you see, like COVID-19 is a perfect example. They reflated the economy in a global pandemic where nobody was really working. Service-based people that could work from their house, they were, but there was a large portion of the global population that just was not even working. And you watched one of the fastest recoveries in the stock market ever happen. So how is that possible? They added more units into the system. It's really that simple. Like, I love using the Monopoly example because it's just something everybody can understand. If you and I and two other people are playing a game of Monopoly, and a fifth person comes over with the bank, right? And they say, hey, we are going to literally triple the money supply right now. Everybody, and they just hand it all out, right? If we were then going to negotiate the values of properties on the board, right? The values of those properties are going up no matter what, because we just have more units that are sitting in our hands as we're playing the game. And if there's one thing that the central banks have gotten really good at since 2008, 2009, is they've become experts on how this rigged game can be manipulated and played with in order to get more units into the system when you have these liquidation events. So because we got monetary baseline and we have credit, when the credit blows up and those promises, I'll give you $100. Sorry, I don't have it. Now the person that you constructed your subsequent deal with doesn't have it. And so that unravels extremely fast. And so when that starts unraveling, think of it like we're playing the game again. Okay. Instead of them adding it into the game, the banker comes over and literally starts clawing 2/3 of the units off the board. Now we have to go and renegotiate everything, right? The value of the properties. I don't care who you are. If we're dealing with Bitcoin in the game, or we're dealing with whatever in the game, the prices of everything are going down by like 2/3 because you just don't have those units in the game anymore. And so people who are trying to understand, why do these things happen? Why do they happen so quickly? How are they able to reflate it so fast? Those are the reasons why, is because they're just jerry rigging the units that are in the system. So could it go down 60%? Absolutely. It could go down 60%. Could it go down 20% and then step in with a really aggressive response and completely reflate it? Absolutely. And could you have the same systematic issues in both of those scenarios? Yes. And I think that's the part that so many people that are trying to make market forecasts don't have respect for how rigged the system is. This system is unbelievably rigged, and it's all up to the hands of a few policymakers that are controlling those monetary units, those fiat units that are in the system. But the thing that everyone can rest assured of hearing that, so like, well, what the hell do I do then? So the thing that I would tell you to rest assured is, I own Bitcoin. They can't manipulate it. Sure, they can step in and manipulate the price, with a bunch of fiat units in the day time frame or the week time frame, but on the long horizon, they cannot manipulate it. All they can do is just keep on adding more and more fiat units into the system. And going back to the monopoly example, if they're doubling, triple, quadrupling the money supply on an annualized basis or whatever it is, the value of that Bitcoin is going to go up, because you can't argue with the fact that there's 21 million of them.
Yeah. Well, just to wrap up, I want to ask you, because one of the things that really spoke to me from your tweet thread is just that this constant manipulation with the central banks doing whatever they can to keep the global markets afloat, it's obliterating the middle class.
Yes.
And it's really hurting the people that I think are truly the fabric of this country and the people who really need to be able to save the most. Can you talk a little bit about what are your concerns, especially because so many people still don't know about Bitcoin and they don't understand it, and maybe they don't even understand how the system is doing this to them?
Yeah. So let's go back to our monopoly example. Let's say you're winning the game by a lot. You have most of the properties, the equity on the board, you own it. And the other three participants, myself included, are, we might own one property. And so when we go around the board, like all that free cash flow or the savings that we have is just flowing right out of our pocket, and it's all going straight into your hands because you hold all the equity. So the government's response, and has been their primary response since 2008, 2009, well, let's add more liquidity into the game so that these other three players still want to play. And so how they're doing it is they're going to you, the person winning the game, and they're saying, Natalie, sell us two more of your properties. We'll pay a premium for them than what you paid. You paid $200 for this one and $300 for that one. We'll pay you $100 more than what you paid for both of those properties. And you're like, okay, sure. So you sell those properties to the banker. That cash now gets inserted straight into your pocket. Now, what are you going to do with that money? Because you're just raking it in. Everybody who's going around just keeps paying you the whole game, right? So what you do is you go to the three remaining players and you say, all right, I now want to buy the only property you have left, and I'll pay up for it. I don't care. I'll pay twice the price you paid. And I'm already cash strapped. I need the money because I'm going to lose. I'm not going to make it around the board to the 200 if I keep playing, unless I sell you my property for double the price. So I sell it to you. I have to. I have no choice. And so this is how the middle class is getting obliterated in the game, is the way that the government is inserting the money is they're going to the bond market and they're bidding up the prices, which is pushing the yields of the bonds down to nothing percent, because that's how pricing works. And the middle class folks who can just barely scratch at the surface are losing all their equity to people that are winning the game. And the people that are winning the game think that it's because of their skill, not because of where they sit. Right. And so this is it. I mean, it's just that simple. And so these actions performed over a decade are just ripping a hole in the middle class. And so you basically have the ultra wealthy, which makes up your 1%. And then you have everybody else who's just trying to make it day to day.
Yeah, I mean, that was a great analogy for the Cantillon effect with Monopoly. I really love it. Awesome. Well, thank you so much. Anything else you just want to share? I think this thread is so important. I'm trying to convey the message of just how bad the inflation and money printing situation is right now. And I just think not enough people understand. And obviously, it just points them in the direction of Bitcoin. They can make their own conclusions, I suppose. No financial advice, but obviously. But any final thoughts?
No, not really. I appreciate the opportunity to come on and talk to you and your audience. And I think the only thing I'll leave people with is, if it doesn't feel right, start asking more questions. Everything that's happening, there's no such thing as a free lunch. Anytime in my personal life I've seen manipulation, there's always a price to be paid for doing and performing that. It's not like it's just you can just do it and there's no consequence. At least there's always a consequence in my life if I ever take a shortcut or do something that I'm not supposed to do. And so I would tell people that this is no different. Read up, get some books on Bitcoin. I'm a huge fan, like you, of Saifedean's work, and there's many others out there that, you read a good book, that can have a profound impact just on your understanding and knowledge of like how the system works. And question everything right now. Question this, what we were just talking about. I mean, that's how you're going to learn.
I mean, it is really amazing how long they can kick the can down the road, don't you think? Like we could be
It
here,
is.
honestly, we could be here 6 to 8 months from now still saying like, oh wow, that bubble's almost ready to pop, and it hasn't.
Well, and if I was going to say, I'm surprised that it took this long for the inflation to start showing up in the gauge. But now that it's here, and now that it's been persistent for as long as it's been, I really think that that's kind of where things are really starting to be a turning point for the actions. Because if they keep doing this and inflation, the CPI keeps coming in at 1%, people don't ask questions. They're just like, oh, okay, well, that's evidently it's not a problem, and they can keep doing QE forever because my inflation is 1 or 2%. But now that it's really starting to kick in, I suspect that it's going to be a little hard to make it go away, especially if they keep doing more quantitative easing moving forward.
Yeah, it'll be interesting how this plays into upcoming elections too.
Yes, very much so.
Well, thanks so much, Preston.
Thanks for having me.